Hello everyone, you're welcome to Young Investors Network series on financial literacy, and today we are going to continue from our previous analysis that we did on GOIL as a listed company on the Ghana Stock Exchange. Our previous analysis focused more on their growth rates in terms of revenue, in terms of dividends, in terms of earnings, in terms of cash and cash equivalents at the end of the period. Today our focus is going to be on ratio analysis. We are going to use ratios to analyze the company to know how it is performing. So we will look at three basic ratios for now. We will look at liquidity ratios, specifically focusing on the current ratio, quick ratio, and then cash ratio. And you look at the profitability ratios. We'll focus on just two: return on assets, return on equity. Then we look at some market price ratios, market to book, book value per share, earnings yield, PE ratio, dividend yield, earnings per share. These are some of the ratios that we will focus on for now. There are others that we will do later on. We have leverage, we have asset utilization. All right, we have leverage, we have asset utilization. We'll focus on them later on. Okay, so let me first of all clear what I have already computed in here so that we can do everything by ourselves. And as I said earlier on, our focus is on GOIL for now. After GOIL, we will look at other oil and gas companies or other companies that are listed on the market, and it is for a 5-year period. Okay, so let's starting with the liquidity ratios. In a nutshell, the liquidity ratios tells us how liquid the company is. All right, when you say something is liquid, you are referring to how you can easily sell that asset and generate immediate cash. All right, so what you can say is you want to know how cash cowed the firm is, or how much cash the company has. All right, so to start with the current ratio, it is the total current assets, as we can see here, total current assets divided by the total current liabilities, as you can see here. All right, so we have 83 pesos. We will drag it for the rest of the years. All right, now we will look at the total. We've done it for total current asset, total current liability. That's for the current ratio. Our next ratio is the quick ratio. The quick ratio simply refers to how liquid the firm is excluding its stock. All right, we say that the firm, in its current asset, it has stocks, account receivable, short-term investment, cash and cash balances. All right, you can see that stocks will take time before you sell them, all right, or before you realize any cash. Account receivables, yes, it also takes time before you can get your cash. And then we have short-term investment, and then we have cash and cash balances. All right, so the formula says that the quick ratio, also known as the acid test ratio, says that to be able to know how liquid the firm is, we should take out the stocks, or the stocks that the company has at the end of the period. So we will do the same thing, current assets excluding stocks. Okay, so we will take out stocks, so total here minus our stocks. Let's put these in bracket. Okay, all right, I hope we are getting the whole show. Then we will divide it by our current liabilities, which is here. Okay, so we drag it here. All right, there we have it. Now we move on to the cash ratio. Now you realize that in explaining the quick ratio or the asset test ratio, we have our asset test ratio. I said that we take out inventory or we take out stock because it will take time before we realize the cash. But you can also see that we have accounts receivables there, which I said it also takes time before you can realize any cash out of it. Okay, so what we need to do, let me see what we need to do, or what proponent of these ratios have brought on board is the cash ratio. The cash ratio will help us to be able to actually tell how liquid the firm is, excluding inventory or stocks and accounts receivable. So we focus on where is the current? Okay, we focus on accounts receivables, short-term investment. We focus on just short-term investment and then the cash and bank balances. These two short-term investments can be in the form of T-bill, repurchase agreement, and all financial assets that have a maturity period of less than a year or 365 days. These are assets that you can easily liquidate them to get immediate cash. Okay, so let me hide. Okay, so our first asset cash ratio, sorry, will be focused on. Okay, so we have current assets, we have short-term investment plus cash and bank balances. Okay, so just these two. All right, sorry, divided by the current liabilities, which is what we have here. All right, so there we have it. Okay, it looks like all right, so there is no short-term investment in 2018, so let's put 0 there. Okay, so there we have it. So now we have our liquidity ratios. To do a proper trend of how the company has fared over the 5-year period, let's select all these and do a simple chart trend analysis for it. Okay, so there we have it. Okay, so let's quickly rename them. So edit chart 1 is current ratio. Okay, series 2 we have quick or asset test. Series 3 we have cash ratio. Okay, so that is it. Let's bring out the data labels. Okay, it will be too clumsy. Okay, yeah, we'll manage. Let's data tables must also come. Then the chart title is already there. Then let's rename it as current ratios. Okay, so let's take it to our empty sheet and then do a simple and a proper. Okay, so as we can see from the, let's take out this. Good. So as we can see from the chart, we can tell that in 2014 their current ratio was 83 pesos, and in 2015 it decreased to 78 pesos. In 2016 it increased to 94 pesos. 2017 it fell back to 83 pesos, and in 2018 it increased, or it maintained the position, or it remained constant, 83 pesos. So as we can see here, the blue line, so it goes, come down, goes up, and then it has remained constant over the period, the two periods. So this tells us how liquid the company is. Mostly industry players says that says that the best should be above 1 or 2, meaning that you can be able to pay up your short-term debts, because we are comparing current assets and current liabilities. Alright, so how do you use your current asset to pay up current debts? So from what we are seeing, focusing on just the current ratios, that is encompassing all the current assets, we can see that the company cannot pay up its current liabilities even up to once or more than once, because in here we are seeing just 83 pesos, like 1:83 pesos, or 0.83 2015. So over the 5-year period, the company has been illiquid in a way, or its current ratio has been very low consistently. Okay, let's look at the current the asset test ratio. Remember, we said the asset test ratio excludes the inventory. Okay, so in the absence of inventory, let's see how liquid the company is, and it is no different from the current ratio. Okay, so we have 72 pesos in 2015 and 14. 2016 we are getting 88 pesos, 75 pesos in 2017, and 78 pesos. Still below 1, cannot pay the current liabilities more than once, or even up to once. Okay, so the best has always been 1 or more, meaning that you can pay it once or twice, 3 times. So if a company has a quick ratio or current ratio more than 1, twice, 3 times, it means that yes, indeed, the company can pay up its current liabilities more than once, or the company is more liquid enough. Let's look at the cash ratio. The figures we are seeing here is no different from the cash and cash equivalent that we saw from the previous analysis. We realized that they were really not liquid. The amount of cash that the company had at hand, at times they had to go beyond their current account, that is overdraft. So look at the cash ratios. We are seeing 8 pesos in 2014. In 2015 we are seeing 7 pesos. In 2016 we are seeing 20 pesos. In 2017 we are seeing 6 pesos, and in 2018 we are seeing just 7 pesos. Viewers, this is for current ratios, and we have explained what it means, how to estimate current ratios, and how you can use it to tell whether the company is really liquid or illiquid. Our next analysis will be on profitability. And I said profitability, we are going to focus on 2 main ratios. They are very, very prominent in the industry. If you want to know how profitable the company is, you focus on just these 2. Not just these 2, there are others, but the basic ones that you normally look out for is return on assets and return on equity. So let's change this. Okay, equity. So return on assets looks at how profitable the company is with respect to its asset utilization. Okay, so let's go. In here we are going to take the earnings before interest and tax, or over here we are going to take the earnings before interest and tax, then we divide it by the company's average total assets. Okay, so we go up here to take out to take the earnings before interest and tax, which is here, then we divide it by the average total asset for the period. Okay, so the average total asset has been estimated for 2014. Let me take it. In a nutshell, the average total assets, let me clear it here so that we can do a proper explanation to it. So the average total asset for a particular period is the previous or the closing total assets. Okay, this is total equity. Okay, let me clear this one too. All right, so that's it. So we are focusing on 2014. So it is the previous closing total assets plus the current closing total assets divided by 2. So in basic terms, you can use this plus this, that is 2013 plus 2014 divided by 2. Okay, or Excel can also help you with average. Just type average as a function in Excel and drag the two figures, you have the same thing. All right, so we will focus more on the average. So let's use average here, then you drag. Okay, so let's drag it. All right, so there we have it. So that is our average total assets. You can see that we'll do same for average total equity, which is the previous plus the current divided by 2. Okay, so there we have it. That is also used in estimating it's also used to estimate the return on equity. Okay, so there we have it. Let's hide this. So in 2014, we are getting return on assets to be 10%. Let's do that of equity, return on equity. In here, we are not going to use the EBITDA, but rather we are going to use the earnings after tax. Okay, so look at the two different. So earnings after tax divided by the average total equity. So earnings after tax for 2014 here divided by the average total equity. So total equity is here. Okay, so there we have it. We are getting 30%. Okay, so let's drag the two here. Let's drag the two here. Okay, now these figures mean a lot to investors. They mean a lot to investors, and they can be presented in two forms, either as percentages as we see here, mostly in percentages, or can be presented in a form of currencies. So we will take the percentage and then let's edit. This is for return on assets. Okay, let's just return on assets, and then we have return on equity. Okay, so let's data, we have the data labels, charts. Okay, now let's rename this as our profitability. Profitability. Okay, so let's take it to, okay, let's take it to our empty sheet and do a proper explanation to it. Okay, so there we have it. We can see that over the years their return on or their profit has been declining. That is focusing on these two, return on asset and return on equity. In 2014, the return on assets stood at 10%. In 2015 stood at 8, 7 for 16, 5 for 17, and in 2018 it went up high to 8%. And then the return on equity, okay, so the two of them have been on a declining stage. The return on assets explains that, or says, or tells us how efficiently or how prudently the management is at utilizing their assets to generate revenue in the organization. So over the years, you realize that from 30%, okay, from 10% declining to 8%, 7%, then the lowest being 5% for 2015. Then in 2018, going up to 8%. It hasn't been good. That is to mean it hasn't been good because it has been on a declining stage. Meaning that if management spent one CD in the organization or on any asset in the organization in 2014, they were going to reap only 10%, or that one CD is going to generate just 10% revenue to the company, which is very, very bad. 2015 it declined to 8, 7 in 16, 5. Now let's look at the equity component. For the equity, you are looking at shareholders' equity, their contribution to management, how management is able to utilize the equity or the fund to generate revenue or profit in the organization, and that has also been on a declining note from 30% to 26, 19, 14, and then 17%. So this has been the performance of GOIL in terms of profitability wise, looking at return on assets and equity. To me, if you ask me, I'll say that it hasn't been bad, but the best analysis will be for you to compare its performance like this to its competitors in the industry. So you take the oil and gas sector, then you compare the profitability or how profitable the other companies are with these ratios, and you can do a conclusive judgment as to whether the company is doing well or not. But to me, on a declining note like this, like that, I'll say it hasn't been performing well. Let's look at our next ratios. That is the market price ratios. These ratios are very, very important, technical, and very, very essential to investors. Okay, our first ratio will focus on earnings per share. Let's start from the basis. We look at earnings per share, as we can see here. Okay, then we look at the earnings yield. Okay, then we will look at PE ratio. Okay, then we'll come and look at dividend yield. Then we come and look at book value per share, and our last will be the market to book price. Okay, so these are ratios that tells us how profitable or how the company is performing or lucrative the company is on the markets and in their books, in terms of dividends that they are paying, in terms of their market price, in terms of their equity, a whole lot. Okay, now I want to do one simple chart for us to see the trend of their share price over the 5-year period to date. Okay, so we will do that in a very simple term, and then I didn't calculate this. You can easily get these figures from the market or the stock market, and then you can easily look at how the share price has been faring. So over the years, the chart is here. Over the years, okay, so this is not really part of our analysis, but let's look at how the share price has performed on the market. So in 2014, the stock or the share price closed at 1.5 pesos. In 2015, it appreciated to 1.40 pesos, and in 2016 it declined to 1.10 pesos, and in 2017 that has been its highest, went as high as 2.69 pesos, and in 2018 it declined to 2.30 pesos. This has been the trend of their share price at the end of each period. Okay, and as at now, it is still trading. As at today, it is still trading at 2.30 pesos 2019. Okay, so let's take this out here. We don't really need it, so we put it here. Now let's go and continue with our analysis. So like I said, we will start with earnings per share. The earnings per share simply the earnings per share, it is simply the earnings after tax divided by the total number of outstanding shares. Okay, so it's just the earnings, the revenue after taking out all that you have to take out, how much that is left, and it is attributed to shareholders or common shareholders. So we go up to take our earnings after tax, which is 20 million here, then divide it by our outstanding, the total number of shares. Okay, it is also up there. So total number of outstanding shares over here we have. Good. So there we have it. So that's earnings after tax all over the outstanding shares. Okay, now we can also see that their earnings per share over the years from 8 pesos to 9 pesos, 9 pesos, 10 pesos, and then to 14 pesos. We will do a chart for it. Let's add our earnings yield. The earnings yield stems from the earnings per share. Alright, so the earnings yield tells us how much, if you are to invest in the company, you are going to earn, or for every cedi that you invest in the company, how much earnings per share that you are going to get. So that too, we will take our earnings per share here, then we will divide it by the market price or the price per share. So there we have it. So that is the earnings yield. So over the years, you can see that from 7.61% to 6.29 to 8.18, then it declined to 3.78, then 6%. Okay, now let's look at the dividend yield. Okay, so the dividend yield, first of all, you can, we have to estimate the dividend per share before we do the dividend yield. So let's clear what we have here. So we have already estimated it. So we have dividend per share, and dividend per share is simply the total amount of dividend paid by the outstanding number of shares, or dividend paid all over the total number of shares outstanding. So we go up. We have the total, so we have dividend paid to be here, then we have the total number of outstanding shares. Okay, so there we have it. That is our dividend per share. Okay, so over the years, you can see that the dividend per share has been very low. 2 pesos, 2 pesos, 2 pesos, 3 pesos, 4 pesos. Okay, these figures, let's give them our currency here. Okay, so we have Ghana cedis. Okay, so there we have it. Now let's estimate our dividend yield. So just like we did for the earnings yield, we will look at dividend yield to be the dividend per share dividend per share divided by the price per share, that's the market price per share. Okay, and they are in percentage, so you drag it to this side. Okay, so there we have it. So now we can chart, or we can do a chart for these four. Okay, no, we can't do a chart for the four of them. Two are in percentage, two are in cities. Okay, so let's take the percentage figures, then do a chart for them. Okay, so that's for the dividend and then the earnings yield. Okay, so let's take these two. Good. All right, it looks like for the decline, we've been seeing it a lot, and yes, so the first one, which is series one, we will edit it, which is the earnings yield here. Then we have the second one, series 2, to be the dividend yield. Okay, so there we have it. Okay, so let's paste it here. Okay, okay, so now let's see how the company has fared. So we explained the earnings yield to be the amount of money that's, or the amount of earning per share that you are likely to get if you are to invest in the company, or for any investment that you make in the company. So over the years, in 2014 their earnings yield stood at 7.61, and in 2015 it declined to 6.29, and 2016 it went as high as 8.18%, and it declined to 3.73% in 2017, and in 2018 it went as high as 8%. Let's look at the dividend yield. Okay, so in this case, for every investment that you make, how much dividend that are you going to earn? Okay, so on your investment or on your shares, so we have dividend yield for 2014 to be 1.90%, 2015 to be 1.79%, 2016 to be 2.27%, 2017 to be 1.04%, and in 2018 1.83%. So it has been stable over the past 2 years, that is 14 and 15. And in 2016 it went as high as 2.27. 2017 it declined to 1.04%, and in 2018 went up to 1.83. These figures speak a lot about the company, and you can use it to tell whether the company is profitable enough on the market for you to invest in it, whether the company is a growth company or a value company. But the question is, like I said, you don't base your judgment on just these figures per this company. You look at the industry average, you compare it with the industry, the oil and gas companies found within the particular industry, then you compare the ratios, then you can do a conclusive judgment. Let's do our charting for the earnings per share. Okay, let's select earnings per share and the dividend per share. Okay, so earnings per share and dividend per share. Okay, wow. So let's see how the company fared. Select. So the first one, series 1, is for the earnings per share. So then series 2 will certainly be for dividend per share. Dividend per share. Okay, so let's showcase the data label. Okay, take out this. Okay, so let's put it here. Okay, since the two of them, they have something in common. Good. So now let's see. Despite these appreciations, their earnings yield and dividend yield has not been faring well. So let's look at their earnings per share. Like I said, it is the earnings after tax all over the total number of what outstanding shares of the company. So if you own a share in the company, how much of the earnings after paying the tax, after everything, how much are you entitled to? So in 2014, we realized that their earnings per share was 8 pesos. So it means that if you owned a share in the company as at then, you were entitled to 8 pesos of their revenue or their profits, that is net profit. In 2015, it increased to 9 pesos. In 2016, it's maintained the 9 pesos. In 2017, it increased to 10 pesos, and in 2018, it went as high as 14 pesos. Now you can see that if the company does not have any or does not do anything to its outstanding shares, it is the earnings after tax or the net profit that will have a great impact on the earnings per share. Okay, now let's look at the dividend per share as well. So over the years, in 2014, dividend per share stood at 2 pesos, 2 pesos in 2015, 2 pesos in 2016, 3 pesos in 2017, and 2018 stood at 4 pesos. So this figures also tells us how much you as an investor will likely get or will get per the dividend that they have paid or dividend that they have declared. All right, so it also speaks a lot about the company, how much dividend that they are paying to their investors. Always we say that companies that pay high dividend, investors will find interest in them. But the question is, if you pay more dividends, where do you then get money to reinvest, to give out more, or to invest in positive NPV so that you increase the market value of shareholders? So in this case, you have to be very, very meticulous as to how much you pay as dividend. So over here for the dividend per share aspect, mostly the dividend payout ratio speaks a lot, and that translates into what we are seeing here. Okay, so that is it for dividend per share, earnings per share, dividend yield, and earnings yield. Our next analysis will be on book value per share. Book value per share. When you say book value per share, what does it mean? Book value per share simply refers to the total equity, of the company divided by, let me see, the total equity of the company divided by the total number of outstanding shares. Yes, so the total equity of the company divided by the total, okay, so the total equity of the company, total equity divided by the total number of outstanding shares. So we know that the total equity is also known as the shareholders worth. So we have outstanding shares here. Okay, so the book value per share is this. Okay, so always investors use this book value per share as a benchmark. Okay, they always hope that the market price of the company will not fall below this book value per share. Okay, so in a simple term, if you take the total equity of the company and you divide it by the total number of outstanding shares, this is how much you are getting. In 2014 you are getting 30 pesos, in 2015 37 pesos, 70 pesos, 78 and 89 pesos. All right, so how much equity does the company have? Okay, so how much equity, how much shareholders fund does the company has, and you dividing it by the total number of outstanding shares gives us the book value per share. Now let's look at the market to book value. All right, and then we'll do a proper analysis for the two. So market to book value is simply the price per share. So the price per share will be the price, the market price of the stock divided by the book value per share. Okay, so in here we are getting 3 cedis 44 pesos, sorry. Okay, so now let's chart these two. Let's chart these two and do a proper analysis for them. So insert, you go to chart. Good. All right, so let's see what we have here. Data labels, data table. Okay, let's edit. Okay, select series 1. Series 1, we have the market to book. Series 2, we have book value. Okay, so there we have it. Let's take it to our good. So let's see. Okay, so now let's see the book value, the market to book value indicates whether the company is a growth stock or a value stock. All right, these two are very, very important to shareholders. Growth stocks or growth, a stock with growth opportunities, mostly investors will have to pay a premium to be able to tap into the growth opportunities in the future. So always their stock prices are high or they are mostly overvalued. Then their value stocks are normally undervalued. All right, so investors who want to make more returns at the immediate or at the interim always want to buy undervalued stocks. They buy now because it is lower, that's the market price is lower than the book value, or the book value is book value of the share. Okay, so this is how the whole thing works. So we can see that in 2014 the book value, the market to book value, that is the market price of the share, comparing it with the book value of the share, was 3 cedis 44 pesos. Now if you look at the market price in 2014, we saw the market price to be 1 cedi 5 pesos, and the book value, the market to book value, is 3 cedis 44 pesos. In 2015 it went up to 3 cedis 77 pesos, and it declined in 2016 to 1 cedi 57 pesos. Now let's look at the market price of in 2016, 1 cedi 10 pesos, and it fell as low as 1 cedi 57 pesos, and in 2017 it went up to 3 cedis 45 pesos. In 2018 it declined to 2 cedis 58 pesos. Now that has been the trend for the market to book ratio, that is the price per share over the book value per share. Like I said, a high market to book value ratio indicates a growth stock or a growth opportunity in the company. So mostly such stocks are overvalued. All right, so if you buy such stocks, there is a high propensity or there is a high prospect of it growing or giving out more earnings in the future. So investors would have to pay more today, okay, to be able to earn such revenues from it. So let's look at and then a very low market to book ratio indicates a value stock. Mostly such stocks are undervalued. Okay, so let's look at the book value per share. So the book value per share in 2014 stood at 30 pesos, and in 2015 stood at 37 pesos, 2016 70 pesos, 2017 78 pesos, and in 2018 89 pesos. So over the years it has increased from 30, 37, 70, 78, and 89 pesos. Now, investors mostly use this book value per share as a benchmark to compare it with the stock's current market price, such that the moment it falls below the book value per share, then it means there is an issue. There's a likelihood that the company can be taken over by another company, or the company is going bankrupt. So investors wouldn't wait for it to fall below the book value per share. Okay, so investors wouldn't want to wait to see that it fall below the book value per share. That is, the market price won't fall below that. Okay, now let's look at our last part 1 ratio, which is the PE ratio, the ultimate PE ratio. So the PE ratio has become a very big ratio that analysts, investors use to determine whether a stock is overvalued or undervalued. Overvalued in the sense that it is trading more than it should be traded on the market. So the market price is higher than it should be traded. That is, its books reflect. All right, and if it is low, then they have investors, especially value investors, will have a great opportunity in there, because they would want to buy when it is low and sell when the true price starts reflecting in the market. So to be able to estimate the PE ratio, we will look at the first one. The second one also works. We will look at the first one, which is the price per share. That's the market price per share divided by the earnings per share. So the market price here divided by the earnings per share. So we have already estimated the earnings per share here. Wow, we are getting 13 cedis, 13 pesos. So there we have it. So let's quickly do a chart for it and see how it has fared over the last 5 years. So let's look at it. Okay, so that's it. Now let's change the name to PE ratio. Okay, so let's take it to our blank sheet and do a proper. Good. So investors on the markets will look out for these ratios, or this ratio, whether the stock is a growth or a value stock. All right, now like I said, a high PE ratio indicates A high P ratio indicates a growth opportunity. Okay, so always you have to pay a premium, or investors will have to pay a premium on it before. So the growth opportunity, so in the foreseeable future, you expect the company to give out more returns or more revenue or more net profit. Okay, so let's look at the trend. In 2014, their PE ratio stood at 13.13%, 13.13 Ghana cedis, or 13 cedis, 13 pesos. In 2015, it appreciated to 15 cedis, 90 pesos. And in 2016, it declined to 12 cedis, 23 pesos. And in 2017, it went as high as 26 cedis, 80 pesos. And in 2018, it declined to 16 cedis, 66 pesos. Now, one would want to find out what's the current, that is as at now, 2019, half year in June. What is its current PE ratio? So we can easily do that calculation here. So the PE ratio, so we need the price, that's the current market price, which is trading at 2 cedis, 30 pesos, divided by the earnings per share. So earnings per share, we are using the previous year's earnings per share. Earnings per share, okay, 14. So in here we have 2.3. okay, so we can see that it is still trading at 16 cedis, 66 pesos. That is its PE ratio for 2019 half year. Okay, that is June. All right, so viewers, this has been some basic analysis or basic ratios that we have explained using the performance of GOIL as a listed company. We've looked at some market price ratios, looking at the market to book ratio, book value per share, earnings yield, PE ratios, earnings per share, dividend yield, and we also compared their return on assets and equities. We also looked at their liquidity ratios for the period that we are looking at. All right, so you can make your own judgment based on what you see here. You can also go out there, download their financials, and do the analysis yourself, and you'll see that in actual fact that has been the true performance of the company on the markets and in their books. So you can also read more, because many of these ratios out there, they have a lot of meanings, a lot of interpretations. I only gave simple, basic, of which I know that it will not be that simple to some people, but I hope you really understand some of the ratios that we have calculated. Our next assignment will be on their asset utilization and leverage ratios, and when we are done, we'll move on to another company known as Total. So Total is also a listed oil and gas company on the market. Just like we did for GOIL, we are going to do the same thing for Total, and afterwards we are going to do who is who on the market. So between Total and GOIL, you look at their performance by comparing the two companies. Okay, I hope you enjoyed. Please like, subscribe, and share. If you have any comments, contributions, you can make. All right, thank you very much. This has been Prosper Apanye of Young Investors Network. Thank you.